A person signs something small. The weight attached to that moment will take years to fully appear. Lending is not simply a product. It is a system designed to generate recurring revenue from a single moment of commitment. Margins on physical goods compressed across decades. Selling the object became less profitable than financing it. Institutions added a financing layer. The customer now paid over time. The margin came from interest, not price. The financing model worked. It worked so well that institutions began building revenue forecasts around borrower renewal, not first-time acquisition. Renewal means the borrower does not pay off the balance. The institution earns again. The borrower's cost quietly extends. Minimum payment structures were calibrated to extend cycles. A smaller required payment meant slower payoff and longer interest collection. The minimum payment became a design feature. It was not a floor of safety. It was an optimized extraction dial. Borrowers accepted these terms because the monthly cost felt manageable. The total cost was invisible at the moment of agreement. Time is the hidden variable. The same debt held for 3 years costs far more than the same debt held for 3 months. Credit scoring systems rewarded engagement with debt. Using credit and repaying slowly was scored better than avoiding debt entirely. The scoring model created a feedback loop. Borrowers needed debt to access credit. Credit required maintaining debt to keep access. Housing, employment, and insurance began using credit scores. The debt system extended into decisions unrelated to borrowing. Participation in the credit system became functionally mandatory. Opting out was not free. It carried invisible access penalties. Institutions issued credit preemptively. The offer arrived before the need. Availability created demand that would not have existed otherwise. Each pre-approval increased credit utilization capacity. More available credit enabled larger balances. Larger balances produced more interest revenue. Student lending followed the same structure. The asset being financed was intangible. The debt obligation was concrete and non-dischargeable. Non-dischargeable debt removes the exit option. The borrower cannot restructure the obligation by changing financial circumstances. Auto lending extended terms from 36 months to 84 months. Affordability was manufactured through duration, not through price reduction. Extending term length locks the borrower in. The vehicle depreciates faster than the debt shrinks. The borrower becomes underwater. Debt-to-income ratios shifted slowly upward across the population. The shift was gradual. No single moment looked like a crisis. Future videos in this series examine how similar structural decisions shaped industries, governments, and financial markets over time. Rewards programs were added to credit products. They made borrowing feel productive. The cost was embedded invisibly in merchant fees and interest. Merchant fee pass-through meant that non-borrowers also paid the cost. The system spread its expense across all consumers without disclosure. Behavioral nudges reinforced borrowing. Spending was made frictionless. Repayment was made effortful. Asymmetry was built into product design. When spending exceeds income, debt absorbs the gap. The system was designed to be the gap absorber of last resort. Wage stagnation increased the system's utility. When income does not grow, credit fills the difference. Demand is preserved. Debt grows instead. Institutional revenue forecasts now depended on borrower non-repayment. Full repayment was a loss event for the lender's modeled income. Securitization packaged individual debts into tradable assets. The original lender transferred risk. The incentive to screen borrowers carefully declined. Risk transfer separated the decision from the consequence. The entity that approved the loan did not hold the loan. Incentives misaligned permanently. Household debt service ratios rose quietly. A larger share of each paycheck moved toward debt obligations before any discretionary spending occurred. Consumption-driven GDP metrics treated debt-funded spending as equivalent to income-funded spending. The measurement could not distinguish the source. Policy interest rates affected the cost of all existing variable debt simultaneously. Rate changes transmitted through millions of household balance sheets at once. When rates rise, variable debt becomes more expensive instantly. Fixed budgets compress. Discretionary spending contracts before income adjusts. Defaults ripple through the system. One borrower's missed payment affects a securitized pool that affects an institution that affects lending capacity elsewhere. Collection infrastructure grew alongside lending infrastructure. The system needed both. Recovery operations became a separate revenue stream. Debt purchasing markets emerged. Defaulted balances were sold at a discount. A new buyer now held the claim and could still collect the full original amount. The original obligation persisted regardless of ownership. The borrower's liability transferred without consent. The system extended the reach of one decision indefinitely. Aggregate consumer debt reached scale where its continuation became economically necessary. Contraction of credit would contract demand and employment simultaneously. The system became self-reinforcing. Dismantling it carried costs comparable to maintaining it. Continuation was the rational institutional choice each cycle. New cohorts of borrowers entered the system continuously. Each generation of participants renewed the revenue base. The cycle required fresh entrants to sustain itself. The system continues. It does not require awareness to function. It only requires participation. And participation was made the default.